Hey guys, and welcome back to the Finance Now podcast. This podcast is purely for informational and educational purposes, and it's my way of sharing my knowledge, research, and opinions with you. I'm Anurag Birla, and not too much to update you all on the macro front this week. I think, for the week ahead, it's just about the CPI anticipation for inflation results on that front and retail sales, so I'll likely be touching on those things next week. But for this previous week, I'd just like to directly jump into some of the key earnings and companies that I took a look at this week. So to kind of briefly summarize, I guess I looked at a couple companies within the AI chip space. Obviously two big names, very well-known names, and one predictable name within the streaming and entertainment industry that I have touched on, covered previously on the podcast as well. So I guess I'll start off with Palantir. A pretty historic moment for the company as they reported their earnings result early this week. The stock was up almost 18% over the course of the week, come week close. And I guess the biggest takeaway from their results was that the firm topped $1 billion in revenue for the first time ever. It topped both Wall Street's estimates and also raised its full year guidance, all due to and it all comes down to the artificial intelligence boom. So looking at the results, their EPS came in at 16 cents adjusted versus the expected 14 cents. Revenue grew to $1 billion versus what was expected to be $940 million. And that marked a 48% revenue growth, right? While analysts were not actually expecting $1 billion quarter until the fourth quarter of this year. So this pull forward was a big step in the right direction for Palantir, and obviously a big confidence boost for shareholders. CEO Alex Karp did speak about on the call how he plans to 10x revenue while also cutting down the number of employees from 4,100 to 3,600. So obviously these are ambitious claims as he aims to grow their top line. He aims to deliver a lot more efficiency than people may have imagined initially. So looking on the guidance front, right, for the full year, Palantir now expects revenues to range between $4.142 billion and $4.15 billion, and that is up from prior guidance of $3.89 billion to $3.9 billion. So it's a significant jump, right? It's a significant step up. For the third quarter in particular, their forecast for revenues came in between $1.08 billion and $1.087 billion. Which beat analyst estimates of $983 million. And, Palantir also lifted their operating income and full year free cash flow guidance, which is a healthy showing for investors and shareholders. Looking at their U.S. revenues, that jumped 68% from a year ago to $733 million. And, with that, U.S. commercial revenues actually nearly doubled from a year ago to $306 million. I guess Palantir has been one of those names that has been in the news because of how much of a boost it's gotten from, Trump's government efficiency campaign. I guess the U.S. government revenues for Palantir jumped 53% from the year ago period to $426 million. Right, the company closed 66 deals of at least $5 million and 42 deals totaling at least $10 million. Right, the total value of its contracts grew 140% from last year to $2.27 billion this year. Net income rose 144% to about $326.7 million or 13 cents per share from about 6 cents per share a year ago. And all these results have now brought the stock price to a level and the market cap of the company to a level where it is now in that elite club of being one of the top 10 most valuable companies in the US. Sure, on a multiples basis, it is likely the most expensive stock or one of the most expensive stocks you could buy, right? It's a forward PE of 251.3, a PEG of 14.8. Yes, it's extremely expensive, and in In a nutshell, no, I don't think I'd be buying at current levels. But the question remains around the fact that this stock has sustained and maintained pretty elevated forward multiples or growth multiples for a while. And despite that, it continues to rise while the fundamentals continue to strengthen, right? I do believe that there will be some multiple contraction at some point, right? There will be a time where people will stop pricing in perfection and this kind of optimism into the growth of the business and perhaps come to a little more sustainable reality, right? There's no debate about how important Palantir is becoming for the American economy, for AI, and I do believe that it is a core technology that they provide, right? They're a definite leader in the entire AI revolution, but buying a great company at a ridiculously poor valuation, if I may say, remains at a time where the company remains at peak bullishness may not be the best idea if you were to time this as best as you possibly could, right? And as hard as it may be at current levels and at current periods of time to deal with FOMO and sit out, perhaps it may be a good idea to be a little realistic in the trajectory of the business, right? At the moment, it's really priced in for perfection for years to come. And I'm just not sure that that kind of sentiment will remain for that long. I do think obviously AI is a massive opportunity and, sentiment will last in a positive light, maybe longer than I initially thought. But there will be other opportunities to buy a great company such as Palantir, right? And I do think there will be multiple contraction at some point, and perhaps just being patient, diligent, and disciplined and waiting for that entry before sniping in would be a more prudent and risk-managed approach. I think one risk that I see with Palantir is that the company is pretty reliant on government revenue. Over 40% of their total revenue comes from government contracts, and that does leave the company somewhat vulnerable to any drastic changes within the administration. And I think that's definitely something people should keep in mind. It has been a darling child of Trump's administration, but it may not last forever. All in all, there's nothing to take away from Palantir shareholders and the company itself. The company has done great. It's been an extremely impressive run. Many times I do wonder that whether selling at $75-$80 a share may have been premature and a mistake, but for me as well, it's a learning process and it was definitely a lesson in holding winners for a longer period of time, not getting too excited by the profits and growth you're seeing in 1 year, and just trusting the direction of a business and sticking with it. And I think, that's a lesson that I learned. It's a lesson I take back. But that said, I'm not going to get tempted into jumping back in at such levels. I still believe the company is fairly expensive, despite how good and how technologically advanced and how much value they're actually delivering for some of their customers. Now, I think moving on to the second company I wanted to talk about, another extremely important company within the AI value chain. It was a much anticipated earnings for AMD, right? In AMD's case, unfortunately, they reported weaker than expected results. And this may be because markets were just perhaps baking in a larger beat than they actually delivered. The stock was down about 5% in extended trading, but over the week managed to recover to being just about 1% down. EPS came in at 48 cents adjusted versus the expected 49 cents, so that was lower than consensus, whereas revenue came in higher than consensus at 7.69 billion versus an expected 7.42. Overall sales were up about 32% from a year ago, which is a solid showing. Right, for the current quarter, AMD actually expects sales of 8.7 billion, plus or minus 300 million, versus expectations of earnings of 8.3 billion. So this puts their lower end above the consensus estimates from analysts. The reported net income during the fiscal second quarter was 872 million, or 54 cents a share, which was a drastic jump from 16 cents a share in the year ago period, right? And their overall sales, as I mentioned, was up 32% from 5.84 billion a year ago. I think this is still a great company to hold for several reasons. Even if maybe the market may have had a short-term reaction to their earnings. And I think the reasons are can be broken down into 4 points, I guess. I'll start with the first. CapEx continues to rise, right? What Lisa Su mentioned on the call was that it's not only GPUs that are seeing the spend, but also CPUs. And we know that big tech have huge amounts of CapEx coming up. It's not necessarily slowing down that much, right? And AMD also mentioned that their EPYC CPU chips, EPY spelt EPYC, they're called EPYC CPU chips, also play an important role in GPU-based AI servers, right? So it's not just the GPUs that people should be talking about, it's AMD's CPU business as well. I think my second point is that I think a lot of the disappointment that came from this earnings call comes from Lisa Su potentially sandbagging. And I say this with a pinch of salt in the sense that obviously we know that the outlook given does not include any China revenue numbers from the China-focused chip, which is the MI308. And export licenses for that are currently pending. That said, I think the worst could already be baked in, right? In other news, we see that the NVIDIA H20 chips are now apparently not safe for China use. This is new news. I haven't dug deep into this, but according to some Chinese state media, they're apparently not safe for China use and consumption. So we're yet to see NVIDIA and Jensen Huang's reaction to this, but I think this geopolitical macro back and forth is going to continue to go on. I think it's a lot more than just about the companies themselves. It's about the two economies as a whole, the two countries. And I would chalk it up to being a bit about noise. And I think that, the worst is potentially already baked in for AMD in the sense that if they were to lose the revenue numbers from China, I still think their business would grow at a very, very healthy amount. And they're continuing to deliver solid innovation in their inference chips specifically. The third point was their client and gaming segment, which also showed strong growth, right? Revenue rose 69% year over year to 3.6 billion, led by record client CPU sales and strong demand for their custom gaming GPUs. So specifically within this segment, gaming revenue increased 73% year over year to 1.1 billion, and client revenue increased 57% to 2.5 billion. So solid growth on both accounts. Of course, it's smaller. It's a smaller part of their overall business, so the growth rates would be higher, but still, it's a very healthy thing to see. And the fourth point, I guess, which ties back into the CapEx, customers that are spending are going to look for ways to reduce their dependency on NVIDIA, who charge a good amount for their GPUs, right? And this will be to AMD's gain. We will see that from... Well, we're already seeing that from Meta and OpenAI, as they're looking to use AMD's newest GPUs. And I think a catalyst for this will be their announcement of their new Instinct MI400 chips that are expected to hit the market next year and will hopefully give them a great opportunity to gain market share in attracting a lot of their CapEx spend from the big tech companies. So with those four reasons, I would say AMD for me remains an attractive company. It remains a company that's continuing to deliver. They're not, obviously, I think they're trying to smooth out the movement in share price, and they don't want extreme volatility. And the price has already had a decent run up this year. And I do suspect that Lisa Su is playing a longer game. She's trying to be tentative in her approach, in her projections, and she's being very careful with what she's sharing with investors. But I like the direction of the business. I like Lisa Su as a CEO, and I think they're continuing to gain market share and mind share for a lot of the customers, and definitely a stock that I plan on holding for the years to come. Now, moving on to, I guess, the third company, the last company that I want to talk about on the entertainment and streaming side. Just the one company here, Disney, right? They reported earnings earlier this week. Earnings had topped expectations, but revenue fell slightly short of analyst projections, and the stock was actually subsequently down 4.72% for the week. So earnings EPS came in at $1.61 adjusted versus the expected $1.47. Revenue was slightly lower, as I mentioned, $23.65 billion versus $23.73 billion, which was expected. It rose only 2%, missing analyst expectations for the first time actually since May 2024. Net income for the quarter was solid. It was $5.26 billion, which more than doubled from last year at $2.62 billion. And I guess adjusting for one-time items, which are primarily related to tax benefits associated with Disney's purchase of Hulu, or Comcast's stake of Hulu, right? Subsequently, Disney then reported earnings per share of $1.61. So, looking at guidance for this company, right? They increased their fiscal 2025 guidance, and they now expect adjusted EPS of $5.85, which is an 18% increase from same time, fiscal 2024. In May, Disney actually issued guidance for the expected full year adjusted EPS of 5.75. So it's a good increase from their initial guidance that was projected, which is a strong sign for the business, right? So, the strong earnings, I guess, if you break them down a bit more, they're primarily driven by the solid streaming and parks numbers. Looking at their experiences segment, and this segment includes, their theme parks, resorts, cruises, as well as their consumer products, their revenues increased 8% to $9.09 billion. The domestic market revenue was up 10% for theme parks, up to $6.4 billion. And, this was specifically driven by an increase in spending inside the theme parks and higher volumes in passenger cruise days and resort stays. And according to Hugh Johnston, their CFO, traffic at the Orlando, Florida park was extremely solid, and that, Disney had its biggest third quarter ever in this regard. An interesting takeaway was that, I guess if you look at the macro picture, right, there has been some concern with the general consumer in the US and the spending state and ability. Maybe the data doesn't show it as much, but I guess the narrative that you see in news show that consumers are maybe feeling a bit of pressure or are uncertain or a bit more worried about potential inflation, and they're going to be more careful with their spend. But Disney aren't seeing that. And, you look even internationally, parks and experiences internationally, the revenue was up 6% to about $1.7 billion. In May, Disney announced that, it reached a deal to bring a theme park and resort to Abu Dhabi, right? And this expansion into UAE, it's not actually part of the earlier pledge from Disney to spend $60 billion on theme parks over the next decade. So this is on top of that, which is a good sign. I mean, they're confident in their growth. I think the UAE has been an attractive place for tourists. It's been an attractive place for people to move as well. And I think for Disney to launch a park there would be a lucrative thing for them. I think it would be a positive thing for them in expanding and growing internationally. For their entertainment segment, and this includes their traditional TV networks, their direct-to-consumer streaming and films, that was up just a bleak 1% to $10.7 billion. Now, breaking this down a bit further, revenue from their direct-to-consumer streaming business actually rose 6% to $6.18 billion. But the entertainment segment as a whole was weighed down by the traditional TV business, which actually saw a revenue dip of 15% down to $2.27 billion. I think in my head, for Disney, there were two big questions. One, how is the consumer doing and are they going to be spending on parks? Two, how is Disney Plus doing? Now, we've spoken about how the consumer is doing briefly, right? We've kind of touched on that, and it's clear that consumers are still spending at Disney, and the CFO doesn't believe that would change too drastically. But touching on Disney Plus, now Disney Plus added 1.8 million subscribers this last quarter, bringing its total to nearly 128 million. good growth, and it has been a good turnaround for Disney from the days of, the days we saw a few years ago of $1 billion burn a quarter, right? This has been a good turnaround in the fundamentals. Now, total Hulu subscribers grew to 1%. It grew 1%, to 55.5 million. Hulu remains a smaller part of their larger streaming picture, and I'm still a bit unsure about how they're going to bundle everything, or if they are, and what kind of I guess what the economics is going to be based on how they report and how people kind of forecast the growth. I guess for Disney, they also expect total Disney Plus and Hulu subscriptions to increase more than 10 million during the current period. So it's going to be aggressive in terms of how Disney try to attract consumers onto their platform. I'll be honest, I've been on Disney Plus before. Disney has great IP, but their streaming platform just doesn't attract me the same way as HBO Max or Netflix does. If we look at, just going back to their financials, if we look at their guidance for operating income, their expectations for DTC streaming has been raised to 1.3 billion for operating income for the fiscal year of 2025. And looking at ESPN, right, which is another subsect of their entire entertainment segment, domestic revenue increased 1% to 3.93 billion. Now, while its domestic operating income dropped 7% to 1.01 billion. So these results were impacted by higher programming and production costs, particularly due to NBA and college sports rights. And this remains like a big question, how Disney are going to navigate this sports field, right? And ESPN on Tuesday actually announced a deal with the NFL in which the Football League will take a 10% stake in the company. And, I guess on top of that, they also announced that the new ESPN streaming app will launch on August 21st. To me, it just seems like traditional TV is becoming a bit of a drag on Disney's business. They're figuring streaming out nicely, and they're addressing that pain point that investors had. Now, Disney has always had solid IP, as I've mentioned many, many times, right? They have good content, and the experience that the company provides in their parks to families, to kids, and even to nostalgic millennials is truly second to none. But lower advertising revenue, lower viewership are all going to contribute to the dying factor of this business, right? And I think what Disney are trying to do is find a way to spin things out, into different streaming platforms, as we see with ESPN, and then subsequently reduce much of the dependency on their traditional TV segment so it can purely focus on the production side of things and streaming side of things. I do like Disney as a company. I do feel like they are taking succession planning a lot more seriously, while also maintaining their moat of being an experience-driven company. And, I think smarter and more prudent spend on IP, not throwing money at random Marvel movies as we saw in the past, has also been helping their case. Yes, there is a lot of competition in this space, but if Disney can crack sports, continue to grow their streaming, which they are, I don't see why they wouldn't succeed. Lilo and Stitch was a success this year, in my opinion. I think obviously Elio has not done too well, but their rollout strategy remains a gray area and definitely a work in progress and an area of improvement for them. And I think if they can touch on these, the price has been consolidating while fundamentals are strengthening. And that's something you like to see with a company like Disney. So if they can fix these things and continue to strengthen their fundamentals, it would perhaps be a good time to open a position in this company. And it's definitely something I would be thinking about. But on that note, I'd like to wrap it up here and remind everyone that anything I say is not meant to be formal investment advice. It's purely my opinion and is for informational and educational purposes only. So with that, I thank you for listening. I'm Anurag Birla, and this is the Finance Now Podcast.